Hello, dear students. So, in this class, we are going to discuss the meaning of leverages concept. So, previous class we discussed this concept like with this small example. If sales is getting doubled, whether profit is going to double or more than the double. Obviously, answer is profit gets more than the double. Okay. So, and that is happening because of this presence of the fixed cost. So fixed cost, again two types are there. One is operating, another one is non-operating or financial. So leverage is nothing but it is a tool which helps to lift the business. What kind of tool? So all the outsiders which supports you to provide funds, by means of accumulating the funds, we can easily start the business. We can easily expand the existing business. For these purpose, so all certain tools are supporting for us. And that is actually called as leverage. Tools in the sense, it may be different tools like shares, debentures, bonds, bank loans, retained earnings, reserves and surplus, all these things are different sources. By means of using these tools, it is easy for us to run the business. That is the concept of leverage. See here the meaning. See, the employment of an assets or funds for which the firm pays a fixed cost or fixed return. We are just including different assets, different funds for our business. Only then we can able to raise the fund and starting the organization in a smooth way. So leverage is nothing but it refers to the debt or the borrowing of funds to finance. So getting their help. Those tools, it supports us by means of getting their help, borrowing from them, we can able to run the business. After a certain period of time, obviously we have to pay the certain amount, certain cost. That is actually cost of capital, different part. Okay. So business proprietors can either use debt or equity to finance or buy the business assets. Yes. So that is what we discussed in capital structure. It is a mixture of both debt as well as equity. Okay. See here. Levered and unlevered firm. Levered firm in the sense high debt component. See, debt is what very high. You are just getting, using the tool in a high proportion. High proportion. That is why high debt component, levered firm. If it is unlevered firm, most of the portion is in equity. Debt is what very less. That is low debt component. That is why it is termed as unlevered firm. Levered as well as unlevered. Imagine that levered firm. 70% of debt and 30% of equity. That is levered firm. If it is unlevered firm, okay, 70% of equity and 30% of debt. That is unlevered firm. Clear? So yes, fixed cost, it plays a major role, and because of the fixed cost only, certain dramatic changes are happening in the profit. Okay, that is why again fixed cost is classified into two types. One is operating fixed cost, another one is financial or non-operating fixed cost. And next is EBIT EPS analysis. So EBIT, earnings before interest and taxes, and EPS is nothing but earnings per share. So how to take all these things, analysis part and all. By means of this, we can able to calculate the actual EBIT, actual EPS, whether we gained profit or not. See here, from sales, if we reduce the variable cost, we'll be getting contribution. Contribution, it is nothing but which this value contributes us for giving the final profit, final earnings. There is not any special meaning for this contribution. Okay. So again, from this contribution, if we reduce fixed cost, it gives earnings before interest and taxes. If we reduce interest from this EBIT, it becomes EBT. Again from this from tax, so we'll get earnings after tax or profit after tax. So this is the way, this is the format for finding out profit after tax. Thank you.